Hello and welcome to Sectors Up Close. I'm David Pollard. Today we're talking financials and my guest is Aaron Anderson, Senior Vice President of Research at Fisher Investments. In a rising interest rate environment, the debate around financials gets fiercer and fiercer. Bulls on the sector seeing an optimum time to invest. The bears seeing a world where inflation is far above interest rates, making real returns hard to find. The Q2 earnings season put that challenge into view, with some big US banks reporting a big drop in investment banking as the market backdrop deteriorated, and others like Wells Fargo seeing a major hit from mortgage lending because of rising rates and from loan loss provisions. But on the plus side for the sector as a whole, US personal debt is relatively low and loan growth has been healthy. As for performance, the S&P 500 financial sector is down year to date, but in the current quarter has seen a major rebound. Its PE is just over 11 compared to over 20 for the index as a whole. The Spider Financial Select Sector Fund has risen over 9% in the quarter, but is also down for the year. Berkshire Hathaway is its biggest holding, followed by the big US banks and S&P Global. Well, joining me now to look at financials is Aaron Anderson, Senior Vice President of Research at Fisher Investments. Aaron, great to have you with us. Let's look at the big picture first of all. Interest rates going up, the money supply going down with quantitative tightening. Is this the right time to get into financials?
Yeah, well, very nice to be with you, David. This is an extremely interesting time for financials, I think, for all the reasons that you mentioned there. There's a lot of push and pull between their various businesses. But I do think there's some real opportunities there right now. On the one hand, you've got flat yield curves that tends to weigh on profitability of lending, and yet lending growth has been very strong, and you're not seeing a very fierce competition for deposits amongst banks. So they've been able to keep their cost of funding very low. So lending still looks very profitable. As you mentioned, some of the investment banking and trading and other types of activities that the big banks engage in, that's been a headwind to date, but looking forward, I think that might look quite a bit better. If equity markets start to improve, as we expect they will, we've seen a little bit of that over the past couple of months, I think all of those businesses will likely pick up as well.
Now, all the positive scenarios assume that interest rates in the US are going to return to, in inverted commas, normalized levels. What are those levels and will we reach them?
Yeah, well, I expect we're going to see a fairly benign interest rate environment going forward, at least at the long end of the yield curve. I think, again, you've got the push and pull of the Fed continuing to hike rates, although there might be an end in sight there. On the long end of the yield curve, though, you're starting to see some improvement in inflation rates, and I think that's likely to keep a lid on how high long-term interest rates are likely to go. And so I think the interest rate environment isn't tremendously positive for financials, but overall, if you look at loan growth rates, those look very healthy. So despite the fact maybe the interest rate environment isn't optimal for banks, it certainly doesn't seem to inhibit them from lending. That's been accelerating quite nicely recently.
Well, let's turn to the risks that the sector faces. Short-term recession could be one, but long-term low growth, such as Japan suffered, is seen as a possible other risk to the sector. What's your view on that, and what are the other risks?
I think really the biggest risk to financials probably has a lot to do with politics and regulation. We're heading into midterm elections here in the US, and it's not uncommon for financials to get a lot of scrutiny amongst politicians. It's very easy for them to kind of tee off on financials to some degree, to kind of put them in the crosshairs as they're campaigning, offering up more regulations that might impair their businesses in some way. So I think of all the sectors out there, as you get into a heated political season like we're expecting going forward, I wouldn't be surprised at all to see financials get some scrutiny. And if that results in some actual regulation, maybe it will, maybe it won't. But that's something that can be a headwind to the performance of the sector.
And what about valuations? Some commentators say that they do, in certain pockets of the sector, look a little bit stretched. Visa and MasterCard are two names that seem to pop up in that context. How do we look for the best in the sector, and what are your favorite picks?
Above and beyond valuations, you just look at how they performed in the downturn. Banks underperformed. Asset managers did quite poorly, as you might expect. Their revenues and earnings are largely based on the value of the assets that they manage. And as you've seen so much turmoil in not just equity markets, but debt markets as well, that's impacted their assets under management. But again, as we look forward and you see equity markets and other markets recover from here, I think that probably moves in the opposite direction. And so within the financial sector, I think some of the most interesting opportunities are in the more capital markets focused companies. Having some exposure to banks, I think, is probably not a bad idea. And some of the areas I think might not fare as well going forward be places like insurance that just tend to be a bit more defensive.
And what about the scale of returns? Could we see double-digit returns anytime soon? What is the timeline that you would attach to that happening?
I think a double-digit return is quite possible. I mean, I think what you often see when you've seen so much volatility is that the recovery can be a lot quicker than many investors believe it can. And I think financials should participate that, and for certain segments of financials, as I mentioned, even outperform a bit. And so certainly I think double-digit returns from here through the end of the year are quite possible for certain industries within financials.
So Warren Buffett is said to have around a quarter of his portfolio in financials. Should we follow his lead? Is that about the right size, do you think?
Well, a quarter of a portfolio feels like a bit much to me. I would advocate for something closer to a benchmark weight. And so for the S&P 500, a global index like the MSCI World, financials comprise anywhere from 10 to 13% or so. I think something in that neighborhood is more appropriate. I might not be as aggressive here with financials as Warren Buffett.
Okay, Aaron Anderson, Senior Vice President of Research at Fisher Investments. It's been a pleasure to have you with us. Thank you very much for your insights. And that is your roundup of the financial sector. I'm David Pollard, and this is Reuters.